Hello everybody, welcome to my YouTube channel, and in today's video I'm going to share with you a detailed analysis of this company called VEEVA Systems Inc. with ticker symbol VEEV. This is my 4 steps analysis approach. First step is to understand the company, study its business overview, and what is its market capitalization. Next is to study the fundamentals of this company. What is its earning capability? What kind of assets is it holding? What is the management efficiency? And what is the company's profitability? Thirdly is to analyze its leverage. Is the company overborrowing? Does it have the ability to repay its debt? Lastly is to backtest to gain conviction on buy-sell strategy. So what is VEEVA Systems Inc.? VEEVA Systems Inc. provides industry-specific cloud-based software solutions for the life sciences industry. Its solutions enable pharmaceutical and other life sciences companies to realize the benefits of modern cloud-based architectures and mobile applications for their most critical business functions without compromising industry-specific functionality or regulatory compliance. VEEVA Systems was founded on January 2007 and is headquartered in Pleasanton, California. So now let me quickly jump to the homepage of VEEVA to show you what are its products and services. VEEVA's products spans across different areas in the life sciences industry in areas such as clinical, regulatory, quality, safety, medical, commercial, so on and so forth. The services it provides includes consultation services and training services. And at the same time, VEEVA partners with other companies in the area of services, content, clinical research organization, CRO in short, technology, and data. Now let's take a look at VEEVA's customers. So one of VEEVA's customer is GSK. VEEVA's customer relationship management underpins our multi-channel strategy and digital acceleration initiative. So let's take a look at AstraZeneca. The return on investment ROI for VEEVA CRM at AstraZeneca was 29% with a cost savings of 30% annually. You can get much better than that. There is another vaccine manufacturing company, which is VEEVA's customer over here, Moderna. VEEVA helps companies such as Moderna bring new vaccines and medicines to patients. So now I'm going to show you a quick video now to let you have a better understanding of the business of VEEVA.
The life sciences industry is changing rapidly. You have huge unmet therapeutic areas. You have to be adaptive. You have to move forward.
VEEVA is a provider of cloud-based solutions for the global life sciences industry. We're working on some of the biggest challenges that life sciences CEOs have, getting drugs to market and marketing and selling those drugs more efficiently, while maintaining compliance with government regulations.
VEEVA was one of the first companies that built a cloud-based application specifically for life sciences. If you're a salesperson in the life sciences industry, your customers are doctors, other healthcare providers. You go to them. You want your information about your customer at your fingertips, and you want your information about your products.
The opportunity with cloud computing was to try to make things that were faster, better, and cheaper. VEEVA's applications for life sciences are really intuitive, both easy to use but also very functionally complete.
This is an application that you can access through the internet that's always up to date.
Our applications run on iPads and Blackberries, PCs. We deliver upgrades into all of our customers seamlessly around the world. This enables them to continue innovating at a pace that they've really never been able to innovate before.
We're trying to help the industry be more efficient on their most critical business processes.
The ability to create data assets across the industry helps life sciences companies get products to market faster, to market more efficiently, and to deploy global business processes in ways that they've never even imagined before.
We live this value of customer success. So when you're customer success oriented, you'll go the extra mile. That makes VEEVA a great place to work, and that makes us successful.
Today, VEEVA is one of the leading companies in cloud computing in the life sciences industry. We've built a company with over 600 employees, and our customers include Pfizer, Novartis, Eli Lilly, but it also includes many companies with less than 100 employees who are working on commercializing their very first drugs.
Life science is not in a steady state. Over the next 5, 10, 15 years, the change will be rapid. You really need a partner that's going to evolve with you. Software as a service, cloud applications, specific industry data. That's the magical mix.
At VEEVA, we're much more than just a software company. We are the industry cloud provider to the life sciences industry.
And coming back to the presentation, this is the market capitalization of VEEVA, which is currently at around $39 billion US. The market cap has increased by 12 times for the past 5 years, from around $3.3 billion US here in 2016, and it grew all the way up to $39 billion US today, which is a clear indication that VEEVA is a growing company. This chart shows the comparison of VEEVA Systems market cap against its peers listed in the New York Stock Exchange. The largest company is Salesforce, which stands at $195 billion US in terms of market cap, followed by Oracle at 191, SAP 151, Twilio 61, Snowflake 49, Palantir 44, and VEEVA is standing at $39 billion US market cap. The industry average is $69 billion US. And over here, there are two key points that I would like to share with you. First is that VEEVA's market cap is considered relatively small. Second is that there is room for growth for the market cap of VEEVA, because it is about 1.75 times lower than the industry average listed in New York Stock Exchange, and it's about 5 times smaller than the largest peer. So you might wonder why is this important? Now let me give you an example. Let's compare Microsoft market cap with VEEVA. I plotted this graph in the same time frame, 5 years, and for Microsoft the market cap increased by 4.4 times for the past 5 years, from $400 billion US here to about 1.8 trillion US. 4.4 times increase in the past 5 years for Microsoft, while at the same time VEEVA in the same time frame increased by 12 times. Now let's take a look what happens to the share price. For Microsoft, in the same past 5 years, the share price increased by about 4.4 times, from around $52 US here to $230 US, about 4.4 times increase. VEEVA, on the other hand, at the same time frame increased from $26 US per share all the way to $260 US, an increase of 10 times. To put things into perspective, if you have invested $10,000 5 years ago in VEEVA, it will become $100,000 US today. Whereas at the same time, if you invest $10,000 in Microsoft 5 years ago, it will become around $44,000 US today. Now this is an example of the market cap. If the market cap of the company you are invested in is too large, is huge, then it becomes very difficult for the share price to increase tremendously. And this is reasonable because we cannot expect that, let's say for example for Microsoft, it is very difficult for Microsoft to jump from $400 billion to 10 times to become $4 trillion company. I wouldn't say that it is impossible, but it's going to take a very long time if it ever happens. Whereas for VEEVA, we have seen that the market cap, the two key points that I share with you, the market cap is small. That means it is more agile and it has the ability to grow at a faster rate as compared to one that has very large market cap. And we also saw that VEEVA has a lot more room to grow in terms of market cap because it is about 1.7 times smaller than the industry average and 5 times smaller than the largest peer. So correspondingly, we can assume that the share price for VEEVA would grow more than a large cap company like that of Microsoft. Now don't get me wrong, I'm not saying that Microsoft is a bad company to invest in or is not worth considering. The large market cap of Microsoft gives investors stability and security. So that is the advantage of investing in a large cap company. But we have to manage our expectations that we should not expect that the market cap to be able to grow another 10 times along with its share price. Now let's take a look at the top line of VEEVA. The revenue of VEEVA grew consistently over the past 5 years. We can see from this chart the blue bars revenue represents the revenue. You can see a very good, comfortable uptrend. The orange line represents the revenue percentage growth, and it gives a very good, comfortable double-digit percentage growth. So I like this company very much for the way that it can continually improve and increase its revenue with a good percentage growth. Now let's take a look at the bottom line, earnings per share. You can see that the earnings are also increasing consistently over the years with very good earnings percentage growth. How about the operating cash flow? Operating cash flow is the amount of cash a company brings in by operating its core business. So we can see that operating cash flow OCF for VEEVA is consistently going up with very good percentage growth, or are above 10%, a double-digit growth. Very good. And same applies for the net asset value. The NAV of VEEVA is also growing consistently uptrend with a very good percentage growth. Okay, next let's take a look at VEEVA's ROE and quality of earnings. On the left scale is the ROE percentage. ROE stands for return on equity, which is the percentage of net earnings over equity. In general, the higher the ROE percentage, the more efficient is the company in generating earnings. Personally, I look for companies with at least 15% of ROE across the last 5 years. And over here, we see that for VEEVA, for 2016 and 2017, the ROE hovers around 11%. Whereas for the last 3 years, from 2018 to 2020, the ROE went above 15%. Next, on the right hand side, the scale is quality of earnings, or QE in short. Quality of earnings is the ratio of operating cash flow over net earnings. A ratio more than 1 indicates that there is more operating cash flow over its net earnings. It's an indication or an indicator of how efficient is the company in converting net earnings to operating cash flow. I look for a ratio of more than 1, and for VEEVA you can see that across the last 5 years it stays consistently above 1, which is a good sign. Well, cash flow is an important parameter to look at because we know that the cash is the bloodline of a company, and if the company has difficulty converting net earnings, which is only registered on paper, if it has difficulty converting the earnings to cash, then this is a company that has a potential risk of going into bankruptcy when there is insufficient cash flow going through the company. This chart shows the net profit margin and net profit margin percentage growth. Net profit margin is the percentage of earnings over revenue. In general, the higher the percentage, the more efficient is the company. So for example, let's say here the net profit margin is around, let's say 27%. That means from the revenue, 27% is ultimately converted to net earnings, whereas the remaining 73% is expended as expenses. For example, it is used to pay for the cost of goods it needs to produce. It's used to pay for taxes, for depreciation, and so on and so forth. So the higher the percentage for net profit margin, the more efficient, the better profitable, the more profitable is the company. Now for VEEVA, we see a consistent, I wouldn't say a consistent uptrend, but I would say that it is showing an uptrend. But unfortunately for the net profit margin percentage growth, we can see that it is not so consistent. From 2016 to 2017, there is even a decrease in net profit margin here. There's a drop. And in 2019 to 2020, the profit margin growth is only 2.3%. So this is a watch point for us to continue to watch whether VEEVA is able to maintain a consistent net profit margin growth. This table is a summary table for all the fundamental ratios that I looked at. The full score is 5 for revenue and revenue percentage growth. We can see that it is consistently on an uptrend with a very good revenue percentage growth, and therefore I give it full score. And the same applies for earnings and earnings percentage growth, operating cash flow and operating cash flow percentage growth, NAV and NAV percentage growth. For ROE, we saw that throughout the 5 years data, 3 years maintained above 15%, whereas 2016 and 2017 it fall below, and therefore I give it a score of 4. For quality of earnings, it is consistently able to maintain a ratio of more than 1, and therefore I give it a full score. And for net profit margin, it scores the lowest because I did not see a very consistent uptrend. It is on an uptrend, but the net profit margin percentage growth is not the double digit that I'm looking out for. For leverage, the debt to equity ratio for VEEVA is at 2.8%, which is a very small percentage. Personally, I look at debt to equity ratio to be less than 100 as an indication that the company is not overborrowing. A debt to equity ratio of 100% means the debt is as large as the equity. Or if I put it in other words, it has enough equity to pay for its debt. A debt to equity of 2.8% means the debt is only 2.8% of the equity. And therefore we can see very clearly that VEEVA is not overborrowing. And at the same time, VEEVA has $1.9 billion of cash and cash equivalents, and total debt of $60 million US dollar. That means it has more cash than its total debt. This implies that the company is in net cash position and it has very low probability of going into bankruptcy because it simply has enough cash to pay off all its debt. Now let me quickly show you where to get this data for free. You can go to Google, type in, let's say, VEEVA, and then you type in Morningstar here. Normally it comes out as the first link. You click it, it will bring you to Morningstar, and over here go to the tab Financial, scroll down to Balance Sheet, and over here you can get the cash and cash equivalents for VEEVA in Q3 of 2021 is 1.59 billion US dollar, and the total debt is 0.06 billion US dollar or 600 million US dollars. Now if you take the total debt here, 0.06 divided by the total equity of 2.11, you get, and you multiply by 100%. Over here you can calculate for yourself the debt to equity ratio, which is 2.8 as shown in my slides. Okay, now let's go back to the presentation. Obviously VEEVA is not overborrowing and it has the capability to repay its debt. And now let's move on to the last portion. This is the weekly chart of VEEVA, plotted for the last 5 years from 2016 to 2021. This is the MA50 weekly line, which I call it the value line. The first thing that I look out for any companies that I'm thinking of investing in is that this value line must show a very consistent uptrend, as shown in this company VEEVA. It has a very, as you can see, it has a very consistent uptrend. So now let's assume that we buy around here 2016 when the first candle jumped above the MA50 line. We buy at this point here is around US dollar 27 US dollar. It's around April 2016. Assuming an initial capital of 15,000 US dollar, the total number of shares purchased will be 15,000 divided by 27, which is approximately 555 shares. The current share price of VEEVA Systems is around 260 US dollar. Now if we take the difference, I take 260 minus $27 multiplied by the number of shares that I hold. And I'm holding 555 shares. My profit will be 129,315 US dollar. Now of course we have to subtract some of the fees that comes along with the purchase and sale of the share, but I think that's a small amount. And the percentage profit, I take 129,315 US dollar divided by my initial capital of 15,000 US dollar minus 1 times 100%. That gives me 762% profit. Now here are 3 key considerations to having a higher chance of being profitable in the stock market. First, the business you are invested in is a good business. Understand what the company does, analyze its fundamentals, and study the leverage, like how I've done it in the earlier portion of this video. and then stay abreast with the company's development. So if you can recall, for VEEVA, we should pay attention to its net profit margin because it did not show a very consistent uptrend, and the net profit margin is not on a double-digit percentage growth. The value line, MA50 weekly line, should show consistent uptrend like that, like this, a consistent uptrend. If there is a major shift in the uptrend to downtrend, we need to exercise extra caution. Just remember, we are making money from the trend. So the reason why we can have a profit of 762% is because it has a consistent uptrend here. Now, it wouldn't be the case if you are invested in a company without this uptrend. Maybe the trend line here turns down, and then obviously the profit percentage will be low, or if not negative. That means you make a loss. Thirdly, let time be on your side. Sometimes doing nothing is better than doing something. Buy and hold strategy works very well for good business with consistent price uptrend. In summary, choose a good business with excellent historical price uptrend. So I've shown you how to find a good business through studying its fundamentals, understand what is the company about, and studying its leverage. And I also show you how to see whether it has excellent historical price uptrend by using the MA50 weekly line. Next is to backtest to build up conviction. And lastly, let time be on your side and follow through. Sometimes I realize that this is the portion why, this is the reason, one of the reasons why people are not profitable in the stock market, because there is no follow through. The moment the stock market corrects or the share price corrects, people panic and then leave the investment and did not follow through. So imagine if we can follow through throughout the 5 years, the profit can be tremendous. In this case, 762%. So follow through is important. And lastly, I hope this video is useful for you. If you like this video, I would deeply appreciate that you could smash the like button, share it with your friends, and subscribe to my channel. These little actions means a lot to me, and they will encourage me to do better with higher quality videos. Thank you so much, and hope to see you at the next video. Goodbye.